Welcome to the Deep Dive. Today we're going to be cracking the code of Wall Street, uncovering the hidden language that different markets speak to each other. Think national treasure. But instead of finding historical artifacts, we're unearthing profitable intermarket relationships. And our treasure map. It's Marcos Katsanos' book, Intermarket Trading Strategies. We've got excerpts highlighting key concepts, real-world examples, and even some metastock code to bring it all to life. Get ready for some aha moments that could seriously change your investing game. I'm joined by our expert guide who can help us make sense of it all. So what are we in for today?
Well, today we're diving into a world where seemingly unrelated events, like decisions made by the Bank of Japan, can actually send ripples through global markets, impacting everything from Japanese stocks to potentially your portfolio.
Okay, let's unpack this. The book starts with intermarket analysis, so it's not just about stocks going up or down, right?
Exactly. Intermarket analysis looks at how different financial markets, stocks, bonds, currencies, commodities, all influence each other. They're all part of this giant interconnected web.
So ignoring those connections is like trying to understand a sentence by only reading every other word.
That's a great analogy. You might get a fragmented sense of what's going on, but you'll definitely miss the full meaning and the context.
The book uses the example of the Japanese yen carry trade. How can something like that impact global equity markets?
Think of it like this. Investors borrow yen at a very low interest rate to invest in a higher-yielding assets elsewhere, like emerging markets. When this happens on a large scale, it injects capital into those markets, pushing asset prices up. But this strategy relies on stable exchange rates. If the yen strengthens unexpectedly, it can trigger a rush to unwind these trades, causing a cascade effect across markets.
Okay, that makes the interconnectedness a lot more tangible. The book then introduces correlation as a tool for understanding these relationships. Even quoting Confucius, study the past if you would divine the future. So are we becoming financial fortune tellers?
Not exactly fortune-telling, but correlation helps us quantify the relationships between different assets. The correlation coefficient tells us how strongly and in what direction two variables move together. A positive correlation means they tend to move in the same direction. A negative correlation means they move in opposite directions.
The book dives into something called Spearman's rank correlation, which isn't as affected by outliers. It feels like this is more than just a technical detail. Why is it important for financial data?
You're right, it's crucial. Imagine using standard correlation to analyze stock returns during a period that includes a market crash. That crash, a significant outlier, could distort the true relationship between the variables. Spearman's rank correlation helps us see through these outliers to understand the underlying connection, giving us a more accurate view of how markets typically behave.
Okay, that makes sense, especially in markets that are prone to sudden swings. Now, how does this tie into the efficient market hypothesis? The book seems to be critiquing it.
The EMH suggests that all available information is already reflected in a security's price, making it impossible to consistently outperform the market. But the book challenges this, arguing that real-world investors consider more than just price. Factors like risk tolerance and liquidity needs can influence their decisions, creating opportunities for those who understand these nuances.
So it's like saying the EMH works in a perfect world, but human behavior kind of throws a wrench into things.
Exactly. Emotions and individual circumstances impact the market. And that's where intermarket analysis can provide an edge. It helps us understand the forces driving those emotions and anticipate how they might affect different assets.
The book mentions the abolition of the uptick rule in 2007 as an example of how regulations can impact market behavior. Can you explain what that rule was and why it matters?
Sure. The uptick rule prevented short selling a stock, unless its last trade was an uptick, meaning it was trading at a higher price than the previous trade. It was meant to prevent short sellers from piling on and accelerating a stock's decline, especially during periods of panic.
So it was like a circuit breaker to prevent things from spiraling out of control.
Precisely. Its removal in 2007 was very controversial. Some argue that it contributed to increased market volatility, especially during the 2008 financial crisis. Without the rule, short sellers could more easily drive prices down, amplifying fear and panic in the market.
So this seemingly technical rule might have played a role in that major market event. It definitely highlights how seemingly small changes can have huge ripple effects.
It's a reminder that market dynamics are influenced by a very complex interplay of factors, including regulations, investor behavior, and global events. Intermarket analysis helps us see those connections and make sense of the bigger picture.
And that's where we'll pick up in part 2. We'll dive into how to use intermarket analysis for actual trading. It sounds like we're just getting started, so stay tuned. Welcome back to the Deep Dive. In Part 1, we uncovered how seemingly isolated events can ripple through the financial markets, impacting everything from Japanese stocks to potentially your own portfolio. Now let's explore how you can use intermarket analysis to actually gain an edge. The book kicks off with practical applications in trading gold. What makes gold so special?
Well, gold is fascinating because it often lags behind other related assets, like the dollar or commodities. By watching those leading indicators, we might be able to anticipate moves in gold prices before they happen.
So are we talking about using the dollar and commodities as like crystal balls for gold?
It's more like using them as clues. For instance, a weakening dollar often makes gold, which is priced in dollars, more attractive to international buyers. So if you see the dollar weakening and commodity prices rising, signaling potential inflation, those are hints that gold prices might follow suit.
Oh yeah, that's interesting. But the book also cautions against blindly following correlations. It gives the example of gold rising against the US dollar in the early 2000s while staying flat against the euro.
Exactly. That period highlights how crucial it is to dig deeper. The flat performance against the euro suggests that the dollar's weakness was the primary driver of gold's rise, not a true bull market in gold itself. Blindly relying on the dollar-gold correlation would give you an incomplete picture.
So it's not just about finding correlations, it's about understanding the forces behind them.
Precisely. Intermarket analysis is about connecting the dots and seeing the bigger picture. The book then shifts to stock indexes, specifically the S&P 500. What can intermarket analysis tell us about the direction of the S&P?
It seems like using correlations with leading indicators like bond yields or international stock markets could be insightful. What kind of divergences should we be looking for?
Okay, imagine bond yields are rising while the S&P 500 is falling. That divergence could signal that investors are becoming more risk-averse, moving their money out of stocks and into the perceived safety of bonds.
That makes sense. It's using the behavior of one market to gauge sentiment and anticipate potential shifts in another.
Exactly. It's like looking at the breadcrumbs to try to figure out where the market might be heading.
The book also delves into specific trading systems using metastock software. One example uses the S&P 500 E-mini futures contract. Instead of getting lost in the code, could you walk us through how this system actually works in practice?
Sure. So imagine you're watching the S&P 500 E-mini and the German DAX futures contract. This system looks for divergences between the two. Let's say the S&P is making new highs, but the DAX is lagging behind, not confirming the move. That divergence could signal weakness in the S&P and a potential reversal.
So it's like using the DAX as a confirmation tool. If it's not playing along, it might be a warning sign.
Exactly. And the system doesn't stop there. It combines these intermarket signals with traditional indicators, like moving averages and momentum oscillators, to fine-tune entry and exit points.
That sounds pretty complex. Is this something a regular investor could realistically implement?
The underlying principle is more important than the specific system. It's about combining different indicators and looking for confirmation from multiple markets before making a trade. You don't need to replicate this exact system, but you can adapt the concept to your own trading style.
The book also discusses dynamic asset allocation, adjusting your portfolio based on which markets are performing best. How practical is this approach?
Dynamic asset allocation is like adjusting your sails to catch the prevailing wind. Instead of sticking to fixed percentages of stocks, bonds, and so on, you shift your investments based on market conditions, potentially maximizing returns and minimizing risk.
But wouldn't constantly shifting your investments incur high transaction costs?
It's a valid concern, but the potential benefits might outweigh the costs, especially in volatile markets. The key is to find a balance between being responsive to market shifts and avoiding excessive trading. There are even ways to implement this approach using ETFs, which can be more cost-effective than trading individual securities.
So even if we don't follow the book's exact system, the core idea of being adaptable and adjusting our sails is what's important.
Absolutely. The market is constantly changing, and clinging to rigid strategies can leave you stranded. The book also covers the FTSE 100, comparing a traditional trading system with one using a neural network. What's the takeaway there?
I was fascinated by the discussion of neural networks in trading. It sounds like the future, but the book points out their limitations, right?
Yes, neural networks are powerful tools, but they're not a magic bullet. One challenge is that their decision-making process can be opaque. You see what goes in and what comes out. But the logic behind the predictions can be difficult to understand.
So it's like having a black box that spits out trading signals, but you don't really know why it's doing what it's doing.
Exactly. That lack of transparency can make it difficult to incorporate additional rules or risk management considerations. The book's analysis even found that adding traditional technical indicators to the neural network system degraded its performance. Sometimes trying to overcomplicate things can backfire.
So it's about finding the right balance between sophistication and clarity.
Precisely. And understanding the limitations of any approach you're using. The book also touches on using intermarket analysis for stock picking. What stood out to you there?
It seems like you could use intermarket relationships to pinpoint promising stocks within specific sectors. For instance, if oil prices are surging, you might look for energy stocks showing relative strength compared to the broader market.
That's one approach. You can also use intermarket indicators to confirm or contradict signals from traditional technical analysis. The book even walks through specific trading systems for oil and gold stocks, highlighting the importance of selecting stocks highly correlated with the relevant commodity or sector index.
So it's about finding the strongest contenders within a strong sector.
Exactly. It's a multi-layered approach, combining fundamental analysis, intermarket analysis, and technical analysis to uncover hidden gems.
The book then takes dynamic asset allocation to the next level with a complete trading system designed to shift investments between different asset classes based on relative strength. Can you unpack that for us?
Sure. This system uses a moving average crossover of the relative strength line to identify potential buy and sell signals. It also incorporates the stochastic oscillator to filter out false signals and avoids buying into overextended markets.
It sounds like this system is trying to ride the waves of market momentum.
That's a great way to put it. And here's the twist. It uses the correlation coefficient to exclude assets highly correlated with the S&P 500 during bear markets. This risk management technique aims to protect capital when the broader market is declining.
That's brilliant. It's like having a built-in safety net to cushion the fall when things get rough.
Precisely. It's about adapting to changing market conditions and protecting yourself from downside risk. The book tested this system on portfolios with futures contracts, international stock indexes, and ETFs, and they significantly outperformed a buy-and-hold S&P 500 strategy.
Wow, that's pretty convincing evidence for a dynamic approach.
It highlights how powerful adapting to changing market conditions can be, rather than clinging to a static approach.
We can't forget about Forex, the world's largest and most liquid market. What unique insights does the book offer for applying intermarket analysis to Forex trading?
Forex trading presents unique opportunities and challenges. Data accuracy can be tricky, and leverage can magnify both profits and losses. The book stresses using high-quality data from a reputable provider and avoiding excessive leverage.
So it's all about having a solid foundation and not getting carried away with the potential for quick wins.
Exactly. A key takeaway is understanding the relationships between currencies and other asset classes. For example, a strengthening U.S. dollar might be correlated with rising U.S. bond yields, while a weakening Japanese yen might be correlated with falling commodity prices.
It's like using those other markets as a gauge for currency movements.
Precisely. The book even outlines specific trading systems for the Japanese yen and the euro, incorporating intermarket indicators, volatility measures, and traditional technical analysis tools.
One of the examples that stood out to me was the yen carry trade, where investors borrowed yen at near zero interest rates and invested in higher yielding assets. It worked beautifully for a while. Then the financial crisis hit.
Right. That example highlights the importance of understanding both the potential rewards and the inherent risks of any trading strategy, especially one involving leverage. Exchange rate fluctuations can quickly wipe out profits or even lead to significant losses.
So even with a seemingly winning strategy, risk management is paramount.
Absolutely. There are no guarantees in the market. You need to have a plan for managing risk and protecting your capital. We've covered a lot of ground in this deep dive, from understanding market interconnectedness to exploring specific trading systems. It's clear that intermarket analysis offers a powerful framework for making more informed trading decisions. Stay tuned for Part 3, where we'll synthesize these insights and explore how you can apply this knowledge to your own trading journey.
Welcome back to the deep dive. We've journeyed through the interconnected world of financial markets, uncovering hidden relationships and challenging conventional wisdom. We've seen how seemingly isolated events can ripple across the globe, impacting everything from Japanese stocks to gold prices to potentially your own portfolio. Now let's bring it all together. What are the key takeaways that our listeners can use to elevate their trading game?
Well, I think the biggest takeaway is that markets don't exist in isolation. Recognizing the interconnectedness of the financial world can give you a much deeper understanding of market dynamics and ultimately lead to more informed trading decisions.
Yeah, it's like we've been putting together a giant jigsaw puzzle, and now we're finally starting to see the full picture. What really struck me was the emphasis on challenging assumptions. The efficient market hypothesis is like a cornerstone of finance. But the book argues that it doesn't always reflect reality.
Yeah, the EMH provides a useful theoretical framework. But real-world markets are influenced by so many other factors, things like human behavior, risk tolerance, even government regulations. Intermarket analysis helps us see beyond those simplified assumptions and understand the forces that are actually driving market movements.
Just like we've been wearing blinders. And intermarket analysis has helped us take them off and see the market with fresh eyes. The book also stresses the importance of adaptability, right?
Absolutely. Markets are constantly changing, so our strategies need to change with them, whether it's identifying different market phases, adjusting our indicators, or even incorporating alternative approaches, like neural networks. Flexibility is crucial.
Yeah, it's like being a sailor navigating uncharted waters. You need to be able to adjust your sails to catch the prevailing winds and avoid getting caught in a storm.
That's a great analogy. It's about being responsive to changing market conditions and not being afraid to challenge your own assumptions.
The book is packed with specific strategies and examples. But I think the most valuable takeaway is the overall framework for understanding intermarket relationships. It's about connecting the dots, recognizing patterns, and developing a deeper understanding of how markets influence each other.
Precisely. It's about developing a holistic view of the financial landscape, recognizing that everything is interconnected.
So what does this all mean for our listeners? How can they apply these insights to their own trading journeys?
Well, I'd say start by expanding your view of the market. Don't just focus on the specific asset you're trading. Pay attention to what's happening in related markets. Are bond yields rising while stocks are falling? Is the dollar weakening while gold is strengthening? Those intermarket signals can provide valuable clues about potential shifts in sentiment and direction.
It's like being a detective, gathering evidence from different sources to piece together the bigger picture. What else should our listeners keep in mind?
Don't be afraid to challenge your own assumptions and adapt your strategies as needed. Are you relying on a trading system that worked well in the past, but might not be as effective in the current market environment? Intermarket analysis can help you identify those shifts and adjust your approach accordingly.
So it's about constantly questioning, learning and evolving as a trader. What final words of wisdom can you offer our listeners?
Knowledge is power, but only if it's applied effectively. Be curious, be adaptable, and never stop learning. The world of intermarket trading is vast and constantly evolving, offering endless opportunities for those who dare to explore its depths.
Well said. It's been an incredible journey exploring the fascinating world of intermarket trading strategies. We've uncovered hidden connections, challenged conventional wisdom, and hopefully equipped our listeners with the knowledge and inspiration to take their trading to the next level.
It's been a pleasure sharing this journey with you.
And to our listeners, thank you for joining us on The Deep Dive. Until next time, keep those minds curious, those charts insightful, and those trading profits flowing.